Hey guys, it's a Dividend guy coming at you with another Robinhood portfolio update. Happy Wednesday. Hopefully everybody's having a GGD, a great green day in the market. You know, I always wish the best for my viewers and subscribers. So for today, we're going to go over the overall portfolio value, of course, the performance by the day, week, month, etc., our buying power, and what we plan on doing with that $200+ as well as the individual holdings and how they're holding up, how each individual holding is performing, and we're going to take a look to see what dividends we have coming in. Then, of course, we're going to take a look at the watch list, which I need to clear out a little bit here. I was just looking at a couple stocks that were down. I'm taking a look at Costco and Berkshire Hathaway. So, by the end of the month, I should have enough cash to purchase some Berkshire at the end of next month, I believe. So, jumping right in for today, we have a little bit of red. We're down $31.33, so not down by much. For that 1 week mark, we're down $700, a 1.5% loss. Then that 1 month mark, we're down $120, a 0.22% loss. Then that 3 month mark, we're up $581, a 1% gain. And then year to date, we are up $3,200 with a 6.5% return. That 1 year mark, we're up $4,800 with a 10% return for the past year. Then all time, we're up $17,703.73, a 50% return all time. So guys, overall, I'm happy with the overall performance. Keep in mind, this is about dividend growth investing on this channel. So my main goal is to have the dividends that get paid to me passively every single month or quarter go up over time. So my passive income grows, and therefore, one day I might be able to live off dividends. That's the long-term goal. So capital appreciation is just the cherry on top. It's not the main goal, but I do like to, I like to see it happening. Next, we have a buying power of $222.57. So, guys, we do get dividends every single month, and as of right now, the best deal I think is Realty Income. But I am looking to diversify a bit and put the money towards other positions like Visa, Apple, maybe Google. So I'm going to let that sit until one of those stocks that I really want to grow, one of those smaller positions, is down enough that I want to put that money into it. So jumping right into the portfolio, we've got Realty Income. There we go. 5254. We have 170 shares. We have around $9,000 worth of market value. Average cost is around $65 per share. Around 17% of the portfolio is in Realty Income. Today we're up $20. Total, we're down $2,100 with a 19% loss. And a dividend coming in July 15th of $44.71. So guys, let me explain real quick why I'm not worried about a $2,100 loss. So Realty Income is my way of getting into real estate without the headache. And as long as that dividend comes in monthly like it would for a rental property, I'm okay with that. So in fact, I like when the stock goes down because then I get a way higher yield. So as of right now, I don't want to add any more to Realty Income, not because I don't think it's a quality company or I don't think that the dividend's going to grow. It's just I think I'm going to get a better overall dividend growth rate with something like Visa or possibly Google or even T. Rowe Price. So I just feel like there are better dividend growth options in the portfolio, but I'm not overlooking Realty Income. Then we got Coca-Cola at $63.54, 15 shares, around $950 of market value. Average cost is $60.54, so we're up a little bit here. 1.8% of the portfolio is in Coca-Cola. Today we're up $6. Total we're up $45 with a near 5% return. So this is still within my buying range. I do want Coca-Cola to be one of the top 3 to 5 positions in the portfolio. So this is one that I do want to focus heavy on reinvesting my dividends, and if I add new capital, eventually I will be adding to this position as well. But Coca-Cola is my favorite soft drink company. I drink it nearly every day, a Coca-Cola product of some sort, not necessarily Coca-Cola itself, but I do drink a lot of Coca-Cola. And so I do want it to be one of the top 5 positions, and in order to do that, I'd have to put more capital towards it. So that's why at this moment, I'd rather put the money into Coca-Cola, simply because I feel like it's more of a opportunity to build a a better business. I think Coca-Cola is a better business overall than Realty Income as well. And that's really what I've been trying to focus on, is really honing in on those businesses that I want to be in my top five, or what I consider a top tier business, and focus more on those. And that actually rolls right into Altria. So right now it's at 45.54. We have 320 shares, $14,000 worth of market value. Average cost is right around $47.30. 30% of the portfolio is in Altria, around 30%. Down 68 to $70 today, down about $500 total, with a 3% loss, and a dividend coming in on July 10th. So here in about 6 days, I believe at the end of probably next Monday or something like that, around next week, we'll have a dividend coming in of $313.60. So guys, when I was talking about quality and building up better positions, this is exactly what I'm talking about. I like Altria stock. I smoked for a few years, a handful of years, and I wanted to get some money out of the investment that I put, money into. Um, it grows the dividend relatively well. The payout ratio is where management wants it to be, but the dividend is not growing at a very high rate. And I mean, it's a declining business overall. They do have pricing power. I mean, Altria, you could say Marlboro is the Coca-Cola of cigarettes. So I see the brand value there, and that's originally part of why I put money into it. But I don't want to keep putting money into a declining business. So I would rather reinvest the dividends in something like Coca-Cola versus Altria. Now, at the current price, it is a good purchase simply because I'd be cost down averaging, but I'd rather put the new cash into something like Coca-Cola. To be completely honest with you guys, Altria is at the bottom of the barrel for me. Um, it would take it falling down pretty heavily, quite a bit more, before I put money into it at like the $40 range. So while I don't think it's a terrible company, it's not where I want to put my investing dollars to really grow the portfolio. I do love the passive income, and it really does fulfill the goal of the portfolio of building, passive income that I can live off of. But I just think that it's going to be stagnant over the next, say, 5 to 10 years. I don't think there's going to be a lot of growth here, and that's really what I'm looking for. Because I'm 28 years old, I have say 4 decades to invest. I just feel like overall, Coca-Cola, Visa, um, even Google is going to do better overall with the dividend growth. And then we've got Apple at 220.27. So guys, I've got a love-hate relationship with Apple. I love the company. It's one of my favorites, but you'll see why in a second. Uh, excuse me, I've got one share, $220 of market value. Average cost is $132 per share. About 0.5% of the portfolio is in Apple. Today we're down. Today we're up, or break even, I guess. Total, we're up $87, 66% return overall here with Apple, and that's why I have a love-hate relationship. So Apple is the stock I'd want to be the number one position. The problem is I just don't want to buy it at these prices because I feel like it's heavily inflated. Now, I'm sure there have been a lot of people that have said, I think Apple's overvalued, or I don't want to buy it, and then it goes up to 500, 700, 1,000, whatever, and they're sitting there holding their one share. So it's difficult because I understand the business. I love the business. I love the ecosystem is really what I want to buy it for, and the services segment is what I really think has the biggest potential to grow here within the company, and I think it could grow by double-digit revenue, and I think that there's a lot of expansion that could happen, especially with AI and stuff like that, because they're dabbling in AI as well. That really wasn't in my original thesis for the company because it wasn't really a thing. But I do think that they have a major opportunity here. And I think a lot of people have overlooked it because they think iPhone sales are going down and that means that the company's losing revenue. They have a lot of money on hand, Apple does. And they could buy like 5 or 6 companies with that cash if they really wanted to. So overall, I just think it's a blockbuster business. I think it's a top tier S plus ranked business that I want more of. It's just I don't want to buy it at these prices, and that could come back to haunt me, But I think eventually the market will correct, and Apple will be at a position in a position or in a price at a price where I want to purchase it. So I'm okay with sitting and waiting. but I do want it to be the single biggest business in the portfolio. I don't know if I want to at a Buffett level of like 40% of the portfolio. I think 10 to 15 would be perfect. But as of right now, I'm not going to be purchasing any Apple simply because of that huge uptick in price. Then we've got AbbVie at 164.08, down $1.88 today. We have 95 shares, around $15,600 of market value. Average cost is right around $95 per share. Around 30% of the portfolio is in AbbVie. Today we're down $176. Total we're up $6,500 with a 72% return here on AbbVie. So guys, this is one of my first arbitrage situations. AbbVie was buying Allergan and the stock tanked. So usually the company that is buying goes down, the company that's being bought goes up. So I had an opportunity to either buy Allergan at a price plus get some cash for it, or just keep my money in AbbVie and watch the stock go up. So that's what I did. I did buy another set of like 15. I think it was 15 shares at a little bit of a higher price, but I'm not touching it here. I'm at $100 per share, and I have a $64 upside per share. So I've made some really good money here on AbbVie. And hopefully, in the future, if I have enough cash, I can really pour into another arbitrage situation, or not necessarily arbitrage, but and another buy, like when a company buys another one, an acquisition situation that could really pay off. I thought about doing that with Warner Brothers Discovery, and I'm glad I didn't. With AT&T, I did also think about doing that with Activision, Blizzard, and Microsoft, and I should have just done it because I missed out on some free cash there. So it's something that I'm not necessarily I haven't done a lot of, but I do like doing that because you get free money out of it. It's just I don't want to sell the shares after, so it would have to be something like an AbbVie situation where I want the business after the merger or acquisition. So I mean, with Activision, I do like Microsoft. It's just I didn't jump on it at the right time. But if you guys know of any merger or acquisitions that you think would pay that pay dividends, let me know. I know like there's been like Moderna did one, Pfizer's done a bunch. I know that there have been quite a few. I just have never jumped. I think the last big one though was the Microsoft Activision one. But I'll keep an eye out. It is something that I'm interested in doing, and if I have the capital, I would love to capitalize on it. Then we got Visa. So, guys, this is going to be the number 2 stock, possibly even number 1 over Apple, depending on how the stocks perform. But Visa's at 268.74. We only have one share at 268.69 is our market value. Then average cost is 268.29, so I'm up a little bit here. Definitely in the buying range for Visa. 0.5% of the portfolio is in Visa. I want that to be up way higher. Only 47 cents up today. 41 cents up total with a 0.15% return. Guys, I want this to be the second biggest position in the portfolio, possibly the biggest after Apple. So this is one of those that I could reinvest in. I don't have the cash or capital to be allocating right now, but I would be excited to purchase more Visa at these prices. Then we got Google at 187.07, 3 shares, $560 of market value. Average cost is $165.60, so I'm up quite a bit here on Google, about $20 per share. We have 1.06% of the portfolio in Google. Today we're up $1.40. Total we're up $64 with about 13% return. Guys, I want Google to be in the top 5 too. So as of right now, I want the positions to go Apple, Visa, Coke, then Berkshire and Google. And Berkshire and Google can switch. Of course, I have a feeling that Apple might overtake Visa. The positions might change just based on overall performance, which is fine. But I do want it to be those top 5. And with Apple newly paying a dividend, that was great news. I was looking at it prior to that. I've looked at it quite a lot. I wanted to dabble in it when it was like $1,000 a share, and I just couldn't. I didn't have the cash at the time. To be spending, $10,000 on 10 shares of Google. So I'm glad that they did the split because I know it doesn't actually build value for the company, but it does make it easier for investors to put cash into it, even though the overall value of the company didn't change. But I do want Google to probably be about 10% of the portfolio. So if we have 15 with Apple, 15 with Visa, probably about 10 for Google, 10 for Coca-Cola. It's about 50%. So I'd say about 10 to 15% all my top five, and then it'll fluctuate just based on performance. But I do want Google to be in that top five. Then we got T. Rowe Price at 116.06, 100 shares, 11,600 bucks worth of market value. Average cost is around 110 per share. 22% of the portfolio is in T. Rowe Price. Today we are up 146 bucks. Total we're up $600 with a 5.5% return. Guys, T. Rowe Price has such a high upside. I'm just going to let it sit, let the dividends keep rolling in and growing. It's a dividend aristocrat. Great capital allocation. Management knows and understands their business well, understands when to boost the dividend, when to buy back shares, and when to just be patient. So I love T. Rowe Price's management. I think for the long term, I mean, if you look at it, I think in the top five, or sorry, the past 5 years, it got all the way up to like 220 per share, something like that. So even at 200, I'd be pretty much doubling. Say I double my total cost, which would be about $23,200, something like that. So I'm gonna sit and wait. If the stock price drops, I'm gonna buy more. And this is one of those that I wouldn't mind it being in my top five. I wouldn't be surprised if it's in my top five, just given the fact that it could climb back up to those levels. But I just love the passive income, guys. It's grown quite a bit. When I originally bought it, I believe I was getting like $100 per share every quarter, and now I'm making $124 per share. So, and I did actually make the mistake a while back of selling out of T. Rowe Price, putting it in VF Corp, and then I got my ass bit on that. So I'm keeping it, and I put it in Tyson Foods before that too. So I was putting money into lower quality companies, and I got my ass bit for it. So I'm not going to be moving it around unless Microsoft drops to like 150 a share or something fucking crazy. Then I would definitely switch out T. Rowe Price. Or if, say, Visa dropped to a level where I could get the dividend income to match T. Rowe prices, then I would consider switching. But that's the only way I would do it, is if Google, Visa, or Microsoft dropped to a level that made sense of switching it out. But I don't think they will. And I like the upside. I like the business, love the management, and the consistency. So even through COVID, even though markets went down, the whole world shut down, they were still consistent with their dividend. And I feel like that when a company shows you how resilient it is, and that it can bounce back, I feel like that's one you should hold on for the long term. One that really values shareholders and doesn't punish them. Uh, During a pandemic, like a lot of companies cut their dividend during COVID. So the fact that there's a handful that didn't, those are the ones that have pricing power, that have a great brand, that people trust, that people still put their money in. Especially asset allocators with the interest rate changes, COVID recovery, stuff like that, and people just being tighter when it comes to inflation, um, and interest rates, and everything's gone up in price. There's a lot of reasons why people have pulled out. Plus, the 5-year Treasury went up to 5%. So there's a lot of reasons why people are pulling out of stocks right now, and that directly affects T. Rowe Price, BlackRock, Vanguard, Schwab, Fidelity, all of them. So if a company can be resilient enough to deal with all of those issues, it's where I want to put my money. I have a lot of faith in management. And then, guys, of course, I'm looking at Costco. So honestly, I just buy a share at this point, and then just uh, cost down average. I want to buy a share for Charlie. I love the warehouse business. I've done a lot of extensive research on Costco. The memberships bring in the majority of the money. They actually lose cash on a lot of their merchandise, but the memberships break even and make them come out ahead. Plus, they also pay a consistent growing dividend, and when they have extra cash within the business, they just fork it out to shareholders, and they pay special dividends as well. So there's a lot of reasons to like Costco, but my main reason and motivation is because it is one of those rare companies that um, Charlie and Warren, I don't want to say disagreed on, but they had different stances on the company. So Berkshire owned it for a long time. I think it was like 25 plus years. And then they sold it a few years ago. Charlie has owned it his whole life. The returns have been wonderful. Now, of course, you can't directly compare it because I'm buying it at a different level than Charlie did because they owned it for so long. But they're great at capital allocation. And if Charlie was willing to hold it for 25 years, if I've done the research on it, and I think that there's great room and potential to grow. They can obviously put more warehouses in China and across the world. If the business expands, then the stock will go up. The cost, the dividend will go up as well, and the overall cost of the stock will go up. So I think there's still a lot of share price. Excuse me. I think there's still a lot of share price appreciation. It's ran really well. The dividends are growing, and I think it could be one of the best growers in the portfolio overall. Then we got Berkshire at 404, guys. I was thinking after that Altria dividend, I could purchase a share of Berkshire. So, guys, I've talked about Berkshire a lot in the past, but just a quick rundown. I love the insurance float. I love the insurance business. I've done a lot of research on companies like Chubb, Allstate, Lincoln Financial, Travelers, and Aflac. I love insurance. I do love that they can take the float, and even though if they're at a quote unquote operating loss, their investments can still push them above, um, above the threshold to be profitable and grow the dividend. So I do understand the insurance business. I just don't know if I want to own an insurance company outright because, life happens, shit happens, and they can easily write bad insurance to make them go under. And not necessarily under as a company, but under on their underwriting, and then they don't make a profit, and it's harder to grow the dividend. So companies like Chubb and Travelers are very good at their underwriting. It's just I don't know if I want to be directly exposed to an insurance company. So my idea is that my main idea for Berkshire and owning it is I want to own Geico, National Indemnity, Wesco. They own a shit ton of insurance, but they have it encapsulated within other businesses. So they have Acme Brick, they have Seized Candy, um, they have a bunch of businesses. They have Pilot, they have, um, excuse me, Dairy Queen. Um, they own shares in a bunch of other companies like CocaCola, Apple, a Bank of America, Chubb. They have a lot of other businesses outside of insurance. So even though insurance is their main business, they have it they have it safely within and surrounded by all these other businesses that produce cash flow, as well as the uh, individual stock holdings that Berkshire owns within its investment portfolio. So I just feel like overall the business is safer because they have other cash flow. They can do the insurance, they can play the insurance game, and they do it very well. And I do think Ajit Jain is it has been and is going to be a phenomenal asset, and I don't think any other insurance company has Ajit Jain or Warren Buffett. So I think they and Greg Abel as well. They understand the business, they understand the culture, and they've ran the business so well that I think that even if they have an underwriting loss, it makes me more confident to own them because they have other businesses bringing in cash flow that'll push that needle for them. So I do love insurance. I just don't love the idea of shitty underwriting, and I feel like Berkshire is more insulated to those types of mistakes because they have other businesses outside of the insurance. So that's why I want to own it. So I might just drop that 313 and that $200 I have and just buy a share of Berkshire. Because I've wanted to own it for a while. So guys, as of right now, I think the best deals within the portfolio are Realty Income. Visa is a really good deal right now, and then I could either buy one of those two or just go ahead and buy a share of Berkshire when I get that dividend. But with that being said, guys, I just want to say thank you so much. Thank you for being patient. We had we lost somebody in the family, so we're just trying to. We had a family emergency, so that's why I've been gone for like a week and a half, and then tomorrow the markets are closed, so I won't be able to do a video. But I will be back on Friday, and then I should be pretty steady Eddie going forward. So thank you guys so much for the patience. I'm excited to be back, and I'll see you guys on Friday with another Robinhood portfolio update. Take care, guys.